everything that's happened in the industry in terms of sales, in terms of what we feel has happened at the store level and kind of at the macroeconomic level. And we're going to go over that, kind of where we see the industry having come from and where we possibly see it heading over the next few years. This next picture, I promise this may be one of the most frightening things that you see in today's webinar, but that would be me, Dan M. Tronchek. I am the editor of Hardware Retailing Magazine and the Vice President of Publishing Operations for the North American Retail Hardware Association. All right, that being said, without any further ado, we're going to dive into Market Measure 2011, the industry's annual report. What we're going to discuss today in more specifics, we're going to take a look at the industry performance, how the industry performed in 2010 and to date in 2011. We're going to look at that performance by type of unit, meaning type of retail outlet. And most of the numbers today we're going to be focusing on our retail performance numbers, and we'll talk a little bit more specifically about where those numbers come from in a minute. We're going to discuss performance by store type, how the different types of stores, hardware stores, home centers, and lumber yards perform throughout the year. And then we're going to discuss what's going on out there in the world and within the industry that is affecting this performance. When I've given these seminars in the past, we get a lot of questions about, okay, where do you come up with the numbers? Why are your numbers a little bit different than what I see from the government's numbers? Why are your numbers a little bit different from some of the other organizations out there that track industry sales? And I like to explain where our numbers come from. And don't panic if you're one of those people that likes to go out there and look at the government numbers, or if you belong to something like the Home Improvement Research Institute, or you look at IHS Global numbers or anything like that. All of our numbers are slightly different because we all look at the industry in a slightly different way. It's just like you guys doing inventory in your stores, or how you guys look at the markets when you're looking at the market size in your area. You all look at it a little bit differently, but the best thing to do when you're looking at someone's numbers is dig a little bit into what their numbers consist of, but to also kind of, it's good to look at all the different numbers that are out there. And when you start doing that, you start seeing that a lot of the trends are the same. It's not so much about the size of the industry or the overall number figure you're looking at, but more the trends that you're seeing within those numbers. So our data, when we look at the industry size and we look at number of units, we get our data from a variety of sources. One of the sources we use is the NRHA's Cost of Doing Business study. If you're a retailer, you're likely familiar with this study, or if you're in the industry, you're likely familiar with this study. We send out thousands of requests for participation in the Cost of Doing Business study every year, and we've been doing this for quite some time. And we get back responses from hundreds of retailers throughout the country that provide us with detailed financial information. It's very detailed information from their income statements and balance sheets, that we aggregate all that data to come up with this Cost of Doing Business report. The performance and the numbers and the trends that we see develop in that Cost of Doing Business report play a pretty big part in what we determine when we look at overall industry size, and certainly when we get further down into the store performance by store type is based almost solely on that Cost of Doing Business research. I would also encourage the retailers that are participating in the webinar today, if you do not participate in our Cost of Doing Business study, I would encourage you to do so. All that we ask is that you send us your financial information. It is all completely private from the moment we get it. It's assigned a number, and the name of your store disappears off of it, and it's all aggregated, so none of your information by store would ever appear anywhere. It's all put into a big aggregate so we can determine what an average store looks like. And just for participating, you get not only a copy of the report, but you get a detailed report back on how your store and your operation performs against the industry averages. And it doesn't cost you anything other than asking your accountant or your bookkeeper to print out an extra income statement and balance sheet and send it to us. And the more stores that we get participating in this, the better the sample size, and the better the sample size, the more reliable the data is for us. So I would encourage you to do it. If you haven't participated in it, you can still get copies of the study by contacting us. Anyway, another source that we use for gathering information for the numbers I'm going to present you is what I would call our circulation research. I'm sure most of you know, NRHA is the publisher of Hardware Retailing Magazine, the industry's leading trade publication. And our magazine, we literally spend hundreds of thousands of dollars every year, what we do call qualifying our circulation. And that means the people that the magazine is sent to. Now, obviously, we want the readers of our magazine to be retailers because they're the ones that get the most benefit out of it. So we spend hundreds of thousands of dollars a year calling retail outlets, researching retail outlets, buying lists, comparing those lists against other lists, and so on, to determine how many storefronts are out there, because we want to make sure they get the magazine. So that plays a big part into when we're determining the overall size of the industry, is that we spend so much money to gather that data for our circulation that it's certainly applicable across applications. Thirdly, government statistics. Everybody knows that the Department of Commerce compiles statistics on retail sales and shares those statistics on a monthly basis. And we also base our numbers in part off of what the government says they see performing out there. Again, I always caution everybody when you look at the government numbers to understand what those government numbers includes. And the government uses something called the North American Industrial Classification System, or NAICS numbers, and home improvement stores are classified under NAICS code 444. And the deeper you dig into that number, there are some other stuff that kind of falls in there as well. So you just kind of be careful when you look at government numbers solely. Way back when they used to use the SIC coding, it used to include like RV dealers and RV parts dealers in with home improvement retailers. And so, even back then it was a little bit cloudier, but they cleaned it up some. But we certainly use those numbers as part of how we drive to the statistics we get to. And then we look at wholesale sales. There are obviously publicly traded retailers out there. There are also a lot of the wholesaling companies that provide a lot of the two-step distribution for home improvement retailers, the Ace Hardwares, the True Value Hardwares, Do It Bests. All of those three that I listed certainly publish their numbers publicly, but we also solicit once a year for this report from even the private companies like Oracle and some of the regional distributors. We solicit their information, and most of them are very compliant and very good, and they give us their information. It gives us a better picture of what's going on out there in the industry. Our sales figures are our industry figures are based on the following types of sales: sales at retail, sales through retailers whose primary business is selling hardware home improvement goods, and sales through retailers who sell core categories within their stores. So what that all means is that we don't count necessarily hardware item sales through a grocery store. You know how you're in the grocery store to pick up your cereal and your eggs and your milk, and they also sell some light bulbs and extension cords? Well, we don't count those sales in with our numbers. We're really trying to look at our numbers as what sells through the home improvement retail channel, as we've defined it. So now that all the methodology is out of the way, what happened in 2011? Well, it's not over yet, and I think to sum up what we've seen in 2011, the year's been kind of a waiting game. 2010 ended on kind of a high note when it came to retail sales, and we all had our fingers crossed this was going to carry through to 2011, and we've been waiting, and we've been waiting, and we've been waiting, and it really hasn't materialized certainly as strongly as we had predicted, but it hasn't materialized to the extent that a lot of people predicted. Ever since 2009 and 2008, when the crash of the housing market started beginning, everybody started saying, okay, I think we've bottomed out, I think we've bottomed out, I think we've bottomed out. And while I think a couple points down here, I say the worst still appears to be over, it does appear to be over, and it does look like we're climbing out of that big hole. But, it's like climbing out of a big hole. You make 3 feet clawing and climbing your way up, and then you slide back down 2 feet. And, just look at the stock market over the last few days as evidence. Oh, my gosh, it's been a roller coaster. And that's kind of what we've seen with the home improvement industry, is for every 2 steps forward, it seems like we're taking a half a step back. So when we dig into some of the numbers in particular, you'll kind of see that while the news overall for 2010 and 2011 was good relative to 2009, it's still not that big jump forward that we had predicted and that a lot of other analysts had predicted. And we'll talk about when that jump forward might occur, if it's going to occur. 2010, as I said, was a bit of a tease. We kind of had a good exit to 2010, some strong sales in Q3 and Q4 in 2010 that we were hoping would carry over to 2011, but then things kind of got tepid, and we'll talk about reasons why that happened. We are not really predicting what everybody's talked about, this double dip, which is something else that's been kind of a waiting game. Everybody says we're going to see a double dip recession, and some would argue, some economists and others would argue that we have never left the recession, so how can you double dip? Well, all the economic indicators that we look at, and that I've looked at, and the Harvard economist that I just saw speak seems to feel that we're not headed for a double dip and that we have emerged from a recession, although it has been a bit of a reluctant emergence. My last point on here is we are still a long way from healthy, and you'll see that in the numbers. We are showing measured growth, but it's still not the kind of growth certainly that we saw in the first half of this century, meaning the 2000s. Not going back to the 1900s here, although there was probably tremendous growth in the industry at that point as well. But back to the 2000s, we were seeing really strong 5% annual growth rate compounded, and 7 and 8 and 9% compound annual growth rate over 5 years. We're certainly not seeing that, and that's not something we feel that we're going to see for a while. So let's look at 2010 and 2011. What were some of the good points? First of all, 2009, which was a bad year. Anybody wants to disagree with me on whether 2009 was a bad year, you're going to have an argument on your hands. 2009 was really one of the low points, 2008, 2009, for this industry. It's all relative. We had still shown growth if you look over a 10-year period, but we were on a track of growth that just fell off of a cliff back then. And when we released our numbers last year looking at 2009, after we went back and after the government revised some of their numbers and we revised some of our numbers, 2009 sales turned out being a little bit lower than even we had predicted. 2009 sales coming in at about $265.2 billion. 2010 results, however, were a little stronger than we had predicted, and 2010 recorded sales of about $277.7 billion, so obviously a significant increase over 2009. But again, it's kind of like saying, I used this phrase last year, but I still like it. 2009 punched me in the mouth, but at least it wasn't Mike Tyson punching me in the mouth, and that's kind of the truth. So it was the best of a bad situation, and 2010 at least started showing some marked recovery that we saw again trail into 2011, but soften from what our expectations were. 2010, the housing market strength energized the industry. And obviously you guys all remember the tax incentives that were in 2010 that really spurred home ownership and people buying homes, refinancing homes, and everybody was excited, and the government thought that these tax incentives will help spur the economy and kickstart it. Well, what they seemed to do was they kickstarted it, but the effect, the carryover effect that everybody had hoped happened just didn't happen. And you could really look at the numbers and see when the tax incentives fell away, so did the activity. So, 2010 was a weird year in that respect. A lot of the things that everybody had hoped would kickstart the economy, a lot of things that we counted on at NRHA to kickstart the industry really didn't happen to as great an effect as we had all hoped. So let's talk about 2011 for a second here. We're going to talk about some of the ugly truths of 2011. In 2010, we predicted marked growth in 2011 based on the rebounding housing market. Like I said, in 2010, we were optimistic, probably a little bit more aggressive in our optimism at NRHA than you saw from some of the other industry watchers, housing watchers out there. However, we were not the only ones that were probably aggressive with that. We'll talk a little bit more about this in detail, but it is certainly the truth. When you look at the statistics for the housing industry, when you look at the demographics that we're facing in the United States, we are on pace to do whatever it is, 600,000, 700,000 housing starts, which is about half of the average that we've seen over the last 20 years, which is 1.5 million. The demographics that are out there show strong support for growth in households. Something has to give. People have to live somewhere. We will soon and someday return to that 1.5 million housing starts average. The $1.5 trillion question is, when is that going to happen? And we were betting that it was going to start happen slowly in second quarter, third quarter of 2011. and it just didn't happen. And there's some more factors we'll talk about on the macroeconomic level that you're all very familiar with that impacted that. So the housing market never took off in 2011, and originally we had estimated sales for the industry of about $294.7 billion this year, and it actually looks like 2011 is going to end up more around the $284, $285 billion range. We might push that up a little bit because the third quarter and fourth quarter look strong. As I say on the last point here, there is still pent-up demand with a few glimmers on the horizon in the housing market and in what we're seeing in the retail market. And we'll talk about Black Friday and all that good stuff that you've been hearing on the radio and all the money that all of us went out and spent this last weekend. And it could either be a signal of things or it could just be an anomaly that we all just got sick of sitting around eating turkey and wanted to go buy stuff. But it is still a glimmer of hope in what's been an otherwise really tepid year for sales. So what did hold us back in 2011? Well, it's unemployment. People don't tend to spend a lot of money when they're not sure if they're going to have a job, or if they don't have a job, or if their unemployment benefits that have been going on for the last 99 weeks are now about to come up. So unemployment, everything you hear, everything you read, every single economist that you listen to, particularly when you talk about the housing market, unemployment is so closely tied to that. Now, every month, again, it's kind of like pulling the arm on a slot machine. When we get the unemployment statistics back, the last couple months looks like there may be a little bit of positive news. We'll see if that carries into 2012. Again, I don't know that it's enough to get really excited about and say, hey, I think it's all going to be better. But I'll talk about this a little bit later, but I think there are a few things that are on the horizon that might magically help that unemployment number. The second thing that held us back and is holding the housing market back and holding the industry back is access to cash. As I'll talk about in a second here, housing affordability is at all-time lows. People should be buying houses. People want houses. The people who have jobs should be able to afford those houses, but the access to credit is so limited simply because what happened with the banks, what happened with their overly flexible lending requirements that got all of the financial institutions into a lot of trouble, they've tightened up. And I know there are a lot of people that are out there that will say, but Dan, people are still getting home loans. People are buying, and that's absolutely true. But if you talk to a banker and you talk to the lenders and you talk to the economists, the average credit score for people that qualify for a 30-year mortgage has increased. The average down payment, good luck finding a down payment less than 20% on a 30-year mortgage, outside of some of the FHA, which is also thinking about tightening restrictions. So unless you have access to credit and cash, meaning on an average home price of about $180,000, having $36,000 to put down and a 720-plus credit score, there are just fewer people out there that are qualifying. Can it be done? Absolutely it can be done. Houses are selling, but to return to the rates we had before, there's going to have to be something done that is going to help people qualify. What we saw before was some of these tax credits, which really helped with one element of that problem, not necessarily the credit score, but certainly helped people achieve that down payment, which is so important for a lot of these younger folks that are getting out of college with heavy student loan debt and maybe not entering a job market that saw the salaries where they were 5 to 10 years ago. Consumer uncertainty. Man, if you look at consumer confidence numbers, those are a real eye-opener. And the truth is there are a lot of things going on in the United States and in the world that just cause people to say, wait a minute, maybe I'll wait to buy that home. Maybe I'll wait to take out a second mortgage. Maybe I'll wait before I move to a new location. Because even if they are employed, seeing the unemployment statistics, seeing the Occupy Wall Street movement, listening to what's going on with the budget negotiations, seeing what's going on in the stock market, listening to what's going on in Europe, listening to what's going on in the Middle East, there are a lot of uncertainties out there that are giving consumers pause, particularly about big-ticket purchases. And I want to really stress this last one because I think it's going to become an important player in the next year, year and a half, and that is governmental gridlock. it is a big catalyst of the consumer uncertainty that is going on right now. What is happening in Washington on both sides, and I'm certainly not going to point fingers here because that would be dangerous and the comments would start flying, so I'm not going to do it, but the gridlock that is being experienced in Washington right now and the inflexibility on both sides is really starting to damage the business climate and the consumer confidence climate in the U.S. And we all hope, I'm sure, that we can push through this, and hopefully the politicians who start seeing the poll numbers, when they see that, will all of a sudden magically be more apt to compromise, which is what the American people seem to want them to do to get things done. So what helped us? We talked about all the bad stuff that helped us back in 2011. What were some of the things that helped us as an industry, as home improvement retailers? Well, the biggest thing, since housing activity and housing starts were down, or were soft, I should say, home repair and maintenance activity continues to drive sales in the home improvement market. You know, again, these are things that I think what we really saw in 2011 that was different from 2010 and 2009 were a lot of this home repair and maintenance activity was what you'd call non-discretionary. I have to make this purchase. I have to replace something that has broken. Now, it's still home repair and maintenance activity, but I think you're starting to see a slight shift towards a little bit more discretionary, where you're starting to see consumers that are replacing maintenance activity with what I would call small-scale remodeling and renovation activity. I want to have my kitchen get a new look, so I'm going to paint it and I'm going to change the cabinet hardware in it. And I think that helped us a little bit in 2011, along with the home repair and maintenance activity, that people are now looking at different projects for their homes. Again, it might not be the $25,000 kitchen remodel, but it certainly could be the $1,100 kitchen makeover or bathroom makeover. Something else that helped us in 2011 was the rental housing market. Was that a lot of home improvement sales, as people were transitioning from being homeowners into rental properties, or as more investors that were out there that were now purchasing homes that were distressed homes and turning them into rental properties, money was flowing into those properties to get them updated and upgraded and inhabitable. The same thing is true. You have generations of people that are coming out of college or leaving high school and leaving the home, and they need to have someplace to live, obviously. So they are looking for a place to live, and quite often right now at a higher rate it is a rental property rather than an ownership property, and every time those rental properties turn over, there's maintenance that needs to be done. It's a different type of maintenance. The expenditures aren't as great as when someone purchases a home, but it's still enough that's stimulating activity in the market. Something else that we're seeing out there that helped 2011 and continues to help 2011 are the niche areas that home improvement retailers have continued to explore. If you look at the numbers for things like sales of pet supplies, which are up, farm and ranch related projects, which are products which are up, the renewed or discovery of hunting and fishing and outdoor life, tailgating, things like that, sales are up in that areas. And most all of those things, when you look at them, it really, I love looking at statistics like this because you start thinking about it and it begins to make logical sense. As more people are taking fewer European vacations or going on 3-week cruises and things like that because the cash flow is uncertain, they're looking for new hobbies and new things to do that are less expensive, that are more grounded, that are closer to home, closer to the community, closer to the nesting of one's roots. And things that make you feel good are taking care of Fido and Kitty, having a little garden in your backyard or maybe tending a few animals on your property, hunting and fishing. Those are things you could do that don't cost a lot of money, but you could still spend money on them. And outdoor living, doing things in and around the yard and garden that help improve your living spaces. So all those niche areas that retailers in this industry have identified, that they're actually able to drive some of those sales that may be lost in some of the other more heavy-duty hardware building activities that they've been able to replace with some of these niches. Finishing out 2011, Q3 will look like, as we started seeing results coming in from Q3, they look like they were pretty strong throughout the industry. Lowe's was the only home improvement player that really reported some tough times in Q3. Everybody else on the distribution side that I've seen so far and on the retail side has been reporting pretty strong Q3. However, in 2010, we also saw a strong Q3 and Q4 improvement that didn't necessarily carry over, so that's just a caution. And unless you're living in a cave, and even if you are living in a cave, if it has to be a cave without TV or Wi-Fi access, to not know that Black Friday was a big hit with retailers. And it's not just about the TVs that were sold. It's also about the fact that consumers were willing to open up their pocketbooks. And I've talked about this with retailers, distributors, and just industry watchers over the last year who have said, people don't have money to spend, and most of us roundly disagree with that. People do have money to spend. They just seem to be more focused and more careful in where they choose to spend that money. So they may be willing to spend it on a $1,000 65-inch LED TV, but maybe we haven't convinced them that they need to spend it on a sink or a faucet or something like that. So there's money to be spent. That's the encouraging thing that we should take out of Black Friday, and that consumers are willing to spend that money on the right product. Now, after Black Friday, just had a conversation yesterday with some big retailers in this industry who reported somewhat mixed reactions. It was funny. It ranged from someone that was all the way up 21%, I think is what he reported for Black Friday this year over last year, to someone that was down 9% year over year. So kind of mixed reactions in the home improvement industry. But again, I think the good news overall from what we get from Black Friday is that consumers are looking to spend money, and hopefully it's good news for the holiday season. And beyond that, hopefully, as we hoped last year, the strong results we're seeing in Q3 and Q4 may spill over into hopefully Q1, Q2, and forward into 2012. So what lies ahead? Well, not that predicting the future was ever easy, but predicting the future today is much more difficult. Having worked on our market measure report for the last 15, 16 years, it did used to be kind of easy for a while there. You knew the industry was growing. You just had to kind of put your finger on how much. And in most situations, if you predict that there's going to be an 8% growth and it comes in at 9% growth, no one's biting your head off. They're all saying, oh, pat yourselves on the back, we did a good job. Well, today it's a lot more difficult to predict. It just is, because there are so many outside influences that are playing on what happens in the industry. We can't just call for measured growth anymore. So what are the key things that are going to influence the way the industry goes? And in a couple slides here, I'm going to show you what we predict to happen over the next 4 or 5 years. And please understand, this is a hypothesis, and there are plenty of hypotheses out there about what's going to happen. And it could all change at the drop of a hat. And I mean, not to be overly dramatic here, but if we decide to go to war in Iran, that could change everything. If the economy in Greece collapses or the euro collapses, that could change everything. And that is a heck of a long way from Main Street America running a hardware store of what decides to happen in Greece or Ireland. But as we've seen right now in the global economy, man, that stuff is affecting everything from interest rates to consumer confidence. I still say, and analysts are still saying, that the current housing situation is not tenable. It just cannot. I mean, again, it's you can't send. I forget what the saying is, or I'll not, at least not say it in polite company. But you can't fit 20 pounds of peanuts into a 5-pound bag. There are people that need to live in homes, and once we have eaten through the inventory, our demographic shift suggests that we have to get back up eventually, within the next 5 years, to that $1.5 million housing start average. This inventory has to be eaten through because there are more people that needs home. Affordability for housing still remains at record levels, and I'll sell you a Ferrari for $10,000, but if you don't have $10,000, you still can't buy it. So housing is affordable right now, but the real question is, can those people that are in the prime new homeowner years, that are concerned about the job market, right out of college, possibly carrying debt, Are they going to be able to find a happy medium that allows them to have the cash to get into a home with the credit accommodations to get into a home? And there has to be a happy medium before where we are, where when you came in for a home loan, they just simply took your pulse and handed you a bag of money, and where we are now, where you really have to be, which is going back all the way to the 1970s, where you had to, where you were severely limiting home ownership in the U.S. And again, I just say it last year, you can't just call for measured growth in the industry because there are so many of the outside forces that are playing in. But every year that goes by and we don't see the big jumps in growth that we have predicted or have thought will come, it pushes back that demand. And while I don't think that they're just going to pull a cork one year and sales are going to explode, you are going to start seeing more dramatic leaps in sales in the industry as we move forward. So here is our forecast moving forward. Like I said, we're looking at 277 last year, 284, jumping up into 294, mostly on the strength of what we think is going to happen towards probably Q3 of 2012, and then 2013 and 2014 getting a little bit more aggressive as the housing market we are predicting is going to start to open up, and as we start making those jumps with housing starts at 200, 250,000 units at a time, is really going to start creating demand within the building sectors and within the home improvement, even on the repair and maintenance side. Don't take our word for it. Here's a second opinion. This is a company called IHS Global Insights that does this study for the Home Improvement Research Institute. It's a great organization. If you're interested, there's their web address. They are predicting measured growth through 2015. They, again, are a little bit more conservative about when that growth is going to happen, I think, than we are. They're predicting kind of the bulk of it to come between 2013 and 2014, with real big chunks dropping in 2014 and 2015 as they see the housing market and some of these economic troubles that we're seeing globally sorting themselves out. So compound annual growth rate 2005 to 2010, not anything to write home about. I think you could probably get CDs that pay more than that, but that's what we saw during that time, and please understand that it was really, flat to nothing, because while you started at 2005, 2006, 2007 on an upward swing, you really gave a lot of that ground back over the last years. But 2010 to 2015, we see about 3.9% growth, which, considering the fact that inflation isn't playing a great factor in there, is it's respectable in light of what the economy is going on. You really want to see if we can get to that high fours, fives, to feel really good about where we're headed, but still, it's still a respectable growth in the light of what's going on. Kind of just reiterating down here on the market share, some of the things that we've talked about already. Gradual improvement through 2012, setting the stage for a strong Q4 2012 and 2013. Looking forward, again, we've already touched on some of this stuff. The housing market remains in a trough. It's so hard when you're standing in the middle of it to believe it. But if you take some time and look up some economic data, just if you want to make yourself feel a little bit better, and it is truly amazing how the economy goes in cycles. Is it possible that we're going to break all the modes and not return to a cyclical economy? Yeah, sure, everything's possible. But is it unlikely? Yes. And most economists will show you that that's the reason you have a 20-year average or a 25-year average on housing starts, is because that's the average. There are peaks and troughs. And we're in a deep trough right now, but given all economic and statistical logic would suggest that we have to be coming out of that trough. The demand is there for houses, as we said. Again, look at some of the demographic information that's out there about the emerging age groups that are coming up, the emerging household sizes, the demand for households. It is all showing that there is an increasing demand for houses and homes out there, and you add to that, houses are cheap. You got two of the three elements to really start a housing push. You got people who want houses, you got cheap houses, you just got to have the conduit in between to connect the people who want the houses, to give them the money and the capital to get those houses. I cannot stress enough that the political environment will have an impact. And I might as well get into that discussion a little bit right now. what we think is going to happen and what a lot of other industry watchers think is going to happen, and we're already seeing happen. We are in the middle of an election cycle, or really at the start of an election cycle. As we move through this election cycle over the next 18 months, it is going to be in the best interest for a lot of people on the political spectrum to foment discord, to convince people that things are bad now, and unless you elect me, things will be, whether it's the incumbent or the people pursuing the office, unless you elect me, things are going to get worse. None of that really helps consumer confidence. But what does help consumer confidence is when the people in Washington on both sides of the aisle start getting scared about being reelected and start thinking, well, we've sat on our hands with compromise. We've sat on our hands trying to create jobs because we've spent a long time trying to point the finger at the other guy and make them look bad, and he's trying to make me look bad. Wow, if we want to get reelected, we got to show some progress. So not only do you have that may be working in our favor, but also when you have a change in administration or when you have a renewal of an administration, if nothing else, there is a certain degree of contentment amongst consumers that, okay, we are either staying the course and we can breathe a sigh of relief and get back to life for the next 4 years, or we have charted a new course and there is reason for hope, not to use hope, sorry, but there is a reason for new conviction. There is a new chart, a new path that we're taking as a country, and I feel a little bit relieved about that. So the election cycle and everything in the politics that are going to play around that is going to have an effect. It's just kind of interesting to see what that effect is going to be. But I do think that on both sides of the aisle, the fact that jobs creation is going to be a top-of-mind topic for politicians, for business owners, for everyone is going to be very important, and hopefully we start continue to move that needle downward. And if we can get unemployment back down into the low 8s, which might be pie in the sky over the next 18 months, but if we can get it back down into the low 8s, a lot of economists have drawn a direct correlation between that and the ability to grow the economy as a whole. So we should all be pulling in that direction. Also, changing consumer habits are going to certainly play a role. And when I talk about that, I talk about the shopping habits. I talk about savings habits, savings versus investment. One of the most interesting things we saw last year was some statistics we did about do-it-yourself activity, some research we did, and we asked consumers why they were engaging in do-it-yourself activity. We had done the same survey, I forget, it was like 5 to 10 years ago, and the number one reason people were engaging in do-it-yourself activity in their homes back then was to add value to their homes. Well, that was like third or fourth, I think, this time around. The number one reason now is to make their homes more comfortable. And that in and of itself says that consumers are kind of changing their thought process around the homes they're in, and they're not thinking about what can I do to add value because I'm going to flip this home every 5 to 7 years. It's more, I'm here for a long haul. What can I do to make this home more comfortable? And I think that's really important for retailers, manufacturers to think about, because that's going to be a shift in the kind of products consumers are looking for. And that means what they're coming to your stores for and the kind of products they want on your shelves. We're going to roll into the performance and what's going on by the different types of store. And again, one of the common questions I get here are, how do you define a hardware store versus a home center versus a lumber yard? So let's roll through that really quickly here so you get a better understanding of what we mean when we say hardware store, home center, lumber yard, and hopefully answer that question ahead of time. We define at NRHA a hardware store as a business operator whose primary business is selling hardware and home improvement items. Well, duh, of course. We say that a hardware store has to carry all the core categories, and a hardware store would have very little lumber and building materials, perhaps a convenience assortment, but nothing more than that. There are no size limitations or sales limitations to a hardware store. You could have a 70,000 square foot hardware store, or you could have a 3,000 square foot hardware store by our definition. A home center, you might ask, well, isn't a 70,000 square foot hardware store a home center? Well, not by our definition. A home center is a hybrid of a hardware store and a lumber yard by our definition. It has to have a minimum 10,000 square foot under roof sales area, carry a full assortment of hard lines as well as a full lumber assortment, and this number statistic includes the big boxes. So The key differentiator between a 70,000 square foot store that we would define as a hardware store and a 70,000 square foot place that we would define as a home center would be the amount of lumber and building materials they carry, which leads us to lumberyards. So what is the difference between a home center and a lumberyard? Well, a lumberyard can be a chain or an independent. It doesn't matter. It has to be included in our numbers, allow consumer traffic, and it has to have sales floors, a sales floor that is under 10,000 square feet. Because if it has a sales floor that's over 10,000 square feet, we would define it as a home center. And it has to have a significant portion of its sales that is attributed to lumber and building materials. So let's look at sales by store type and how we get to these industry numbers. 37.8 billion hardware stores, 172.7 billion home centers, 67.2 billion lumber yards, and you can read it across there and see where the gains came from and went and where we think they are going. Hardware stores have been in a good position over the last several years because, as you can imagine, with sales of building materials falling off, the other two store types rely more heavily on building materials to generate profits. The hardware stores are typically more associated with home repair and maintenance items, and that market has not softened as much, certainly, as the building materials market. The big boxes are heating up their wars. Again, it's a discussion. And we kind of saw some things happen with Lowe's here, with Lowe's announcing that they're closing stores and poor financial performance, and Home Depot coming out with a stronger financial performance. So you're going to see not necessarily wars on the retail front, but certainly wars on the stock and shareholder front amongst those two store types. And so that's kind of interesting to see how that's going to play out. Lumber yards have been in transition, and if we have any lumber retailers on the call, you probably have likely given thought to this or engaged in this, but more and more lumber yards, and at least the successful ones over the past several years, have begun to transition their business model from necessarily serving only a pro with a very little bit of consumer walk-in traffic to really trying to do things on their sales floors to re-attract that consumer traffic, adding fashion items or adding more fixtures or adding a showroom, anything to get the consumer in the store and capture more of those sales. So they're in a bit of a transition right now, which could likely serve them well. And I'm sorry, these numbers are in billions here, not millions. If I misspoke, I apologize. So lumber yards have been in a bit of transition to try and go back to, dare I use the phrase that was kicked around about 15 years ago in the industry, a dual path strategy that would allow them to service both consumers and pro-oriented traffic. And another big segment to watch that is heavy into home improvement sales is farm and ranch. There are more and more home improvement stores that are focusing on farm and ranch assortments. As we go back to the niche areas, it's not a niche for a lot of dealers. It is a core part of their business. And the farm and ranch industry in a lot of the U.S. has experienced growth, which is spurring sales, not to mention the hobby farms. But in addition to that, certainly throughout the upper Midwest or pushing into the Pacific Northwest, some of the oil industry up in that area that has kind of had renewed interest and renewed business is also driving sales growth. So there are some areas of the country that are experiencing business booms around what's going on, and that could certainly have effect on how performance by store type goes. Number of outlets serving the industry, you can kind of see what we're looking at there. A lot of times, I'd say probably almost once a week, I get a call or we get a call here at NRHA from a reporter who's doing a story about a store in their town that's closing down, and can we tell them about how many stores have closed in the last 20 years and how the industry has just been torn asunder by the big boxes and put these poor mom and pops out of business. And we always try and set them straight. We never want to hear about a store going out of business, but like any industry, there is an ebb and flow. There is a time for doing business and a time for closing doors. And the truth of the matter is, you can look back to the past, I think it's 28 years now that we've been doing this market measure report, And it is true, there has been a decline in store units throughout the industry, but it has been nowhere near as dramatic as people think. However, as you can see, over the next 5 years, there's going to be about a half a percentage point decline in store units. Big boxes, are obviously have slowed their growth once Home Depot hit saturation point and could not really achieve the kind of earnings lift that they wanted by opening new stores. They really put the brakes on, and Lowe's is even looking at going negative with store growth. So that being said, store growth is in decline through consolidation, but it's not as dramatic a decline as a lot of people may suspect. Top 10 chain performance. These are 2009 numbers. The percentage of sales controlled by the top 10 retailers in the industry has continued to decline, which is kind of interesting because for years and years it kept growing and growing and growing. But then about 3 or 4 years ago, there was a dramatic shift where the percentage of sales, the percentage of units has always been dramatically off because you have the big box numbers, the Lowe's, Menards, Home Depot mixed in there, and they control a large volume of sales without controlling a large number of units. But their percentage of sales as an industry has declined over the last 4 years, and what's interesting about that is those sales still exist. And as you've seen, even with the small growth that we've experienced, there's sales growth occurring that's natural sales growth. So that sales growth is going somewhere, and it speaks well for the different models in the independent segment that are managing to absorb that growth. So let's look at the financial profile for hardware stores. These are 2010 numbers because obviously we don't have the complete 2011 numbers, and all of this data is off of our cost of doing business study. The average hardware store had sales of about $1.3 million a year. The high profit store just a tick over $2 million a year. Gross margins, you can see a high profit store, which are the top in terms of net profits, the top quartile in terms of net profits, had a margin of 43 points. Payroll expense, high profit stores lower, and that's a theme you're going to see as we look at the store type performance across all these store categories. Is the gap between the high performers, the most profitable stores, and the average stores continues to widen. And in most every case, that increasing gap is being driven by tighter expense controls and greater margin opportunities. So what that typically says when you look at that, and it really happens with a couple differences that we'll show you here as we go, what that really suggests is that, logically, those that fall into that high profit category are simply better at retailing. That doesn't mean that an average store can't transition and become a high profit store, but the real difference is they are buying product better, they are pricing it better to drive a higher gross margin, and they are doing a better job controlling their expenses, which, if you do those two things, drops greater percentage profit to the bottom dollar. Sales in our study year to year, obviously we get about 500 or 600 hardware stores that send us their data. Every year that number is not the same 500 or 600 hardware stores. 200, 300 might return and do it year after year. Then we might get 200 or 300 new ones, and those 200 or 300 new ones, some of them will come back, some of them won't. So you can never take our cost of doing business study and compare year to year and say, oh, the high profit store sold 2.1 million this year, but only 1.7 million last year. So I can directly say that sales at high profit stores have grown by this much, or sales at the average store have grown by this much. So what we did this year to try and make that a little bit easier is we did look at the comparative stores, the stores that participated last year and this year in the study. Sales at those stores was down 1.8%. Now, again, please, this is one measure. This is not the case, certainly, but it could be that those stores that continually come back year after year are horrible stores, and the high profit stores aren't included in that group. But it's just to give you a little bit of do a little bit of comparative purposes to see what the like stores were like year over year. Cost of goods sold is up for comp stores, and margins at those comp stores were down. So my guess is that some of those comp stores were probably not amongst the top performers. As I said, though, the polarization between the average store and the high profit stores continues to widen. High profit sales, for the first time in a long time, actually I believe it's for the first time we've done this study, eclipsed the average of $2 million in sales mark. How are they doing it on the sales side? How are they producing that much more in sales than the average store? Well, it's higher customer traffic. 117,000 per year versus 80,000. I mean, that's a lot more customer traffic that is coming through those stores. And you couple that customer traffic with the better control of expenses, and you get the better profitability. Home centers, again, it's a very similar picture that's painted here. The average high-profit home center is selling more at the top line. Their gross margin, but you say, Dan, wait, their gross margin is a full 2 points lower. Well, remember what we said in our definition of home centers is that home centers derive a portion of their sales from commodity items, lumber and building materials. So what this tells us is that the high-profit home centers, while they have a lower margin, they are probably doing a better job at capturing that commodity business and doing higher numbers of transactions than the average stores. Expenses, the same thing. It would stand to reason that commodity items tend to be a little bit less reliant on employee interaction to sell. So the total operating expenses at a high profit store are almost a full 4 points lower than a average store, which results in profit before taxes at the average store 2.1% versus a 5.3% in a high profit store. For this group, the comp store sales were up 7.3%. Like with the hardware stores, the high profit typical gap begins to widen. Expense control is still a really big key. We already talked about margins are actually lower. They're attracting more customers, 110 versus 85.5. And for the comp stores, again, which is a mix of the typical and high profit, gross margins as a comp store group were actually up 0.5%. Lumberyards, again, very much what you see with the home centers. Lumberyards top line sales are up. Gross margin is down, which is, again, a good indicator that the high profit yards are the yards that have been able to continue to capture that sticks and bricks sell. So they are working on lower margin but just higher volume. The expense is way lower for a high profit store than an average store. They are running leaner and more efficiently. And while there is still, I'm not going to say there's no one getting rich in lumber because that's certainly not the truth, but profit before taxes of 2.7% is nothing really to write home about. And before I start making fun of an average store that just showed a profit before taxes of 0.9%, it's a heck of a lot better what they had posted, which was negative over the last couple of years. So Lumberyards comp store sales were down 8.8%. We talked about high profits are attracting the quality sales. Customer count is fairly even between the two store types, but transaction size is dramatically different. The high profit yards are getting almost a full 70% more per transaction than the average stores. So again, it's those quality customers. It's the people that are engaging in building products or projects that are coming to those yards. And as I said, a typical yard actually turned a positive profit of 0.9, and I think they were at a negative 0.6 or 7 the year before. So the gap is wider across all types with the high performers. So we're about wrapping up here. Macroeconomics still playing a big factor in where the industry goes. As we said, it's getting much tougher to predict. You never, probably 10, 15 years ago, you'd never be sitting here thinking what happens in Greece or Ireland or Syria is going to affect what happens at the local Home Depot or at the local hardware store, but in today's world, it does. The election should offer turmoil then relief across all economic and housing fronts. And lastly, I can't say enough, the demographics and affordability suggest that the housing demand is there. It's just when is that going to start eating into the inventory and creating housing starts. So that is all I have. I will say at this point we do, I believe, have some questions. And My producer is handing me some of the questions. But as I'm taking a look over these questions, I want to point out a couple things. One, there is my email down there, dant@nrha.org. Please feel free to email with the questions, comments, concerns that you may have had about this or anything else you'd like to talk about. This webinar has been recorded, so a recording, if you came in halfway or you missed something, or you just want to show it to other people at your company or something like that, it is recorded and will be available through the NRHA.org website in probably a week or so. So you can download it and record it there. And we're actually in the process of transitioning most of those web recordings to also put them up on our YouTube page so you can watch it. And that's something that's happening over the course of the next month or so. But the recording is available. Let's see. I had a question here about could you give some figures on power tool accessories? And the truth is we do not track down to that item level. There are organizations out there that track to that item level. Unfortunately or fortunately, they typically charge for that information, and we just don't track down to the power tool accessory level. Once every, 5 to 10 years, we do a report that kind of looks at that, but nothing that would be recent enough or valid enough for me to get into at this point. The data is probably a little bit old. Organizations like NPD and HIRI.org, H-I-R-I, Home Improvement Research Institute. I know I sit on HIRI's board of directors, but they do something called a product purchase tracking study that I believe if you're not a member of HIRI, you could probably purchase the report from them or simply become a member of HIRI and get access to all that material. But unfortunately, we do not track that. We had another question about were the sales in millions or billions, and I think I clarified that they were in billions. And at this point, does anybody have any other questions for me? Well, that being said, I'd like to thank you all for attending again. And if you have a question that you want to ask me offline, shoot me an email and I'll be happy to handle it for you. And thank you all very much. And I hope you have a great day and a very productive rest of the year. Happy holidays and a great new year as well. Thank you.